Hello, my name is Stephen Halpern. I work at Advisors 123, and this is the seminar Gear Up Training. This training will last around 30 minutes or so. The script in this seminar is below the slides where necessary. I am not going to go through every single slide with you regarding the script. I'm going to point out information that you will need to know additionally so that you are not one-dimensional. You need to have a depth of knowledge. The seminar itself will take around 25 to 30 minutes. You will then have a half an hour of question and answer. After the question and answer, you will be setting up the one-on-one appointments. At the beginning of your seminar, you are going to have families sign in. You are then going to hand them the seminar evaluation form or workshop evaluation form that is on the screen now. You can download this from our website. Do not hand out any Department of Education materials or any other materials when the families walk in. If you do, they will end up spending more time reading those publications than paying attention to your presentation. At the end of the presentation, when they hand in the workshop evaluation form, you are then going to offer them some publications when you're setting up the one-on-one appointment times. It is important to collect the seminar evaluation form at the end of the seminar because that is going to be your lead sheet. When you're presenting your seminar, please do not take any questions. Answer the questions once your seminar is completed. There are some questions that you cannot answer because they are personal questions. You'll ask the families to put their questions on the back of the seminar evaluation form and ask them at that point to hand them to you, and you will answer their questions specifically when you meet with them on the one-on-one. If you are asked about the cost of the seminar during the seminar, do not answer that question. The reason why is because some families might be embarrassed or they might be put in a peculiar situation because they might not have the money to pay. We do recommend that you charge $16.95. That's the national average. There are some areas where you can charge $19.95 or even more. There are some areas or some cases where you might want to only charge $12.95. We require $8.45 per report. Anything above that, you receive back as a rebate check or a marketing allowance. If you are not an IAR, Investment Advisor Representative, or an RIA, Registered Investment Advisor, you most likely cannot receive fees anyway. So all fees will go to our company. Over the years here, I've helped hundreds of people or thousands of people save thousands of dollars on any one of our services. I'm going to begin the seminar itself. The very first slide goes over or creates an issue here in regards to debt. What I'm going to tell you is not on the slide, but this is to give you depth of knowledge for questions that you might be answering at the end of the seminar. Students take out loans. Every student is expected to take out loans, whether they go to public school or private school. The loans for students are the Stafford loans. The Stafford loans for students do not require cosigners. I'm sure you are aware that students have little or no credit when they're going into college. There are two types of Stafford loans. The interest rate on these loans now is 4.35%. It might be going up. The first loan is a subsidized Stafford loan, where the government actually pays the interest on the loan until the student is out of school 6 months. The unsubsidized loan, Stafford loan, is where the interest begins to accrue as soon as the loan is issued. The first year subsidized loan is $3,500. The second year subsidized loan is $4,500, and the third and fourth year subsidized loans are $5,500 each. Now, for each of these years, the government will also issue the unsubsidized Stafford loan. Students must complete what is called a master promissory note in order to receive these loans. If you add that up and this is in the script, it will be $27,000, not including any interest. So when a student graduates from college, due to the unsubsidized Stafford loans, they will owe more than $27,000. There's another loan for parents called the Parent Loan for Undergraduate Students, or the PLUS loan. Parents can borrow up to the total cost of college, less any gift aid provided. These loans are not subsidized. If a student is going to end up with $27,000 in loans and more, the parents borrowing $25,000, $30,000, $40,000 a year for one child are going to end up with over $100,000 in loans. These are very significant. The loans that are issued from the government are called direct loans with a capital D. If a parent qualifies for a direct loan, a PLUS loan, at this point it's 7%. If the parent does not have good credit and require a cosigner, and they have to go to an outside lender, the interest rates can be from 7.4% up to 11.9%. On to the next slide here. This is where you provide your name, your company address, phone number, email address, and website you will provide, or we will provide for you. You will give a background on yourself, a biography. Make sure that you state specifically why you are holding these seminars for families. Basically, you want to point out that you understand the situation that they're in and you want to help them. That's the bottom line. It's expensive no matter where children go. It's important to understand that it's not just tuition, fees, room, and board. There are additional costs. It's not just the living expenses include wardrobe, transportation, additional food costs, not counting the meal plan, cell phone bills, costs for computers, car repairs if they have a car insurance, car payments. It can easily run $5,000 a year. If you add that $5,000 onto a conservatively priced college, let's say a $20,000 a year state school, over 4 years, it's easily $100,000, and that's just for one child. In 2015, Congress put a cap on college cost increases to no more than 15% a year. The problem is that's still around 5 times the rate of inflation. The next slide goes over college costs. In this example, this student lives in Florida. Please understand, and this is a statement that you need to make to the families during your presentation, is that just because a school looks to be very expensive does not mean in the end it will be that expensive, due to the fact that these better schools provide an awful lot, or the lion's share, of financial aid. Of course, this is creating a need, but once again, you have to explain to parents in regards to a 4-year cost of college of a prestigious private school that $287,000 is the cost of the school without financial aid. In regards to incomes being too high, I want to give you an EFC breakdown here. EFC is the expected family contribution, and it is based on the adjusted gross income, or AGI. In case you're wondering, it's the last line on the first page of the tax return. It's line 37. The numbers I'm giving you now are based on 3 members in the family with a standard deduction. The more members in the family and the higher their deductions, the lower the EFC is going to be. But with an AGI of $50,000, the EFC is going to be around $6,000. With an AGI of $100,000, the EFC is going to be around $16,000. With an AGI of $150,000, the EFC is going to be around $25,000. With an AGI of $200,000, the EFC is going to be around $43,000. And with an AGI of $250,000 a year, the EFC is going to be around $54,000 a year. But if you compare that to the cost of private schools that are running $63,000 to $72,000 and more, there is still need-based aid available for parents who even earn up to $250,000 a year. It's been statistically proven that parents who make more money do send their children to the more expensive schools. Additionally, in regards to the expected family contribution, one would divide that by the number of students going to college at the same time in a family. So if there are two students going to a college, and going to colleges, and if the EFC is $54,000, you're going to divide that in half, so it will be $27,000 per child. So there's absolutely financial aid. If the student did not qualify for a merit scholarship, then there's need-based aid, obviously. And if there's no need-based aid, well, the student should have good grades and receive merit-based aid. And lastly on this slide, by the time you're done and the family understands the ins and outs of college funding, it's not really simple, easy, or fair if you don't understand the process. So let's go through the process here. The first thing a family needs to understand is what all financial aid officers use in calculating financial aid, which is this formula: the cost of attendance minus the expected family contribution is remaining need. This is a very important slide. Families need to understand that their expected family contribution is based on their income and their assets. A family might tell you at this point in time that they can go online and calculate their expected family contribution. There are online calculators. The point is that one must make sure that the calculator is correct. The assets that are entered must be entered correctly. In my experience, I've been doing this since 2002, almost every questionnaire I receive has 529 plans in the student's name. And through the training and the training manual, you know that students are assessed at 20% and parents are assessed at only 5.65%. But the issue really is that students are beneficiaries of 529s. They are not owners of 529s. I'm going to go into 529 discussion for a moment here. If a parent owns a 529 plan, it's assessed at 5.65%. If a non-custodial parent owns a 529, or a grandparent or a rich aunt or uncle, it's not counted as an asset. But the problem is that when it's used to pay for the student's bills, it's added onto students' income. So there has to be techniques understood to work around this 529 contribution dilemma. I've also seen custodial accounts where the parents choose to take the money back, and that's not legal. I've seen trust funds not counted. Many parents speak with accountants, and accountants tell the families that the trust funds are not counted without realizing the fact that almost every trust fund has an education clause. In that education clause, it actually becomes assessed in the student's name if the student is a beneficiary. If the parents can use the money, if it's left to them for education, it's assessed in the parent's name. So trust funds are counted. I've also seen parents put 401k investments in as regular investments because they see them as mutual funds, not understanding that those mutual funds are in retirement plans, which are not counted. But the bottom line is, not only is it important to understand what the EFC is, but to understand the schools that provide the greatest amount of financial aid. We have a database of 4,000 schools, almost 4,000 schools, and we can filter out or filter in the schools where the student wants to go in regards to area of the country or state, what the student would like to major in, and the schools that provide the greatest amount of financial aid. The issue here is that parents can buy books. There's a book called Peterson's 4-Year Colleges. The book is 3,000 pages long. It alphabetizes the schools by state, and then each state alphabetized by school. The problem is it does not specifically show you a rating of which schools provide how much in remaining need in order. It does not show the schools that provide or have the highest faculty-student ratio, or the percentage of students that graduate in 4, 5, and 6 years. And these are very important pieces of information, but it takes hours upon hours of research for a parent to be able to narrow these down, especially when you're also looking for a specific major. So here's an example of step number 1, lowering your EFC if possible. The issue here is that the initial EFC of 18,000 is from income and assets. The EFC of 10,000 is with the assets not being counted. Like I said, there's a script for each one of these slides where necessary. We are not trying to play a shell game here. There's no smoke and mirrors. We're actually letting the family know on this slide what is counted and what is not counted. The issue here is that life insurance and annuities cannot be purchased online if the parents even manage to get to the 9th page of the 10-page instructions. The Department of Education makes it look very easy to file a FAFSA online. But when one is filing it online, there are specifics that are very hard to determine if one does not have the instructions. So this is step number 2 in regards to what the EFC is and what schools provide and what the ramifications are. Please recall the formula. We take the cost of attendance. We subtract the expected family contribution, and we're left with remaining need. Since Miami provides 100% of remaining need, the out-of-pocket cost is $10,000. Now, if we compare it to University of Central Florida, which looks to be much less expensive, we apply the same expected family contribution, and we're left with remaining need. But University of Central Florida only provides 54% of remaining need, which leaves $2,900, $2,934 short. You take the $10,000 expected family contribution, you add on the $2,934, and you're left with $12,934. It actually costs more, in this case, to go to a state school than it would to go to a private school. This is what parents don't understand, and I'll talk to you about guidance counselors later on. So where's the financial aid? Obviously, grants and scholarships. We already discussed loans, they're limited. Work study, a student can only earn $3,000 per year. The good part about work study is that it is not added on to the expected family contribution as income. Where it comes from, the private schools have billions of dollars in endowment funds. It's free money. If the school wants a student, they will pay to have the student go. In regards to the government monies, we've discussed loans. Now let's talk about the free money for a moment. One of the only sources, there are 2 sources. The main source is the Pell Grant, P-E-L-L. The maximum is $5,920 a year. The way it's calculated is you take the number 5,921 and you subtract the EFC from that. Whatever's left is the Pell Grant. The issue here is that if a parent or parents earn $50,000 or more, their minimum EFC is around $6,000. There is no Pell Grant money. The other grant money out there is called the SEOG, or SEOG, Supplemental Education Opportunity Grant. You must qualify for the Pell Grant in order to qualify for the SEOG. So there's no free money from the government. And then outside sources. This is important to understand. All the money that is received from outside sources, it reduces the remaining need that is provided by the school, the need-based aid. There is a website called fastweb.com. Fast like the opposite of slow, web like what a spider weaves.com. Over 1.5 million scholarships on that website. The first issue is the student has to register on FastWeb, so they must enter their their age, and their email address, so their email address is being sold off. Every scholarship requires a separate application and a separate essay. And every student in the country is looking for these scholarships. They're typically pizza money, $250, $500. And as I said earlier, the schools reduce the amount of remaining need you're receiving. So the only reason why outside scholarships will work is if a school is providing very little remaining need. State schools typically provide between 50 and 70% of remaining need. Private schools provide between 80 and 100% of remaining need. When we look at where the aid is coming from or how much is available, please look at the sky blue piece of the pie. This is not in the script. I'm just giving you the example here. Let's say we have a school that costs $20,000 a year. and the parents are earning $100,000 a year, and they have an EFC of $15,000. So if we use the formula, taking $20,000, subtracting $15,000 EFC, and you're left with a $5,000 remaining need. The first form of financial aid that every school will offer is the Stafford loan of $5,500 that first year. So in that case, there is no free money offered in that aid package. It is strictly a loan. What we're looking for is to get the student the dark blue piece of the pie. We help families. We provide a customized student profile report. Not only is it the financial needs analysis and the college aid enrollment information, at the end of the seminar, you're going to be going over every other point that we provide. But in this case, what we're doing is, since we're explaining steps 1 and step 2, we are showing that we provide that information to them. In order to receive financial aid, you must file the FAFSA. It must be filed every year. It can be filed as early as October 1st. The problem there is where parents file it that early, they might be making mistakes. They might have failed to reposition assets, and if they reposition assets after that, then they can only file it the next year and the year afterwards, but not for that year. They might file their information incorrectly. But please keep in mind that the FAFSA this year was using 2016 returns. It will always use 2 years prior. So the freshman year of college requires the junior year tax return. The sophomore year of college requires the senior year tax return. If you're asked when to start this program, the best time is before December 31st of the sophomore year of high school, because if there are any capital gains that are taken, it will not show on the junior year tax return. We fully expect students to start using our program in the freshman and sophomore year of high school. We also expect them to ask us to rerun their data in the summer of the senior year of high school with new colleges and updated costs. So we do not just sign them up and leave them alone. We walk them through all years of college. The FAFSA can be filed as late as June 1st for new students. Many schools don't even know their financial aid budgets until the end of March. So there's really no reason to rush into filing the FAFSA. Just make sure all the information is correct. The CSS profile is required by many of the schools that provide the greatest amount of financial aid. If one does not file the CSS profile, then one will not receive merit-based aid given out by the school. It's a very complicated form. Believe it or not, some questions are required and some aren't required, and it confuses the family to no end. This is not the Wild West. We do not just file the FAFSA with information a family provides. We make sure that the information is correct before it is submitted. Families are told that the FAFSA is free to file, and it is. It does not mean that it's easy to file, but it is free to file. At the end of this presentation, I will go through, let me go through now issues with the guidance counselors. This is something you probably should not be stating during your seminar. If there are guidance counselors there, you might insult them. But let's talk about what guidance counselors can and can't do. I worked as a teacher for 5 years in high school. I offered my assistance in financial aid. The guidance counselor in the senior year told me that I should not give financial advice, of which I totally understand. But on financial aid night, all the guidance counselor told me to do was to help the parents and students log on to the FAFSA and complete it. I was not to give any financial advice. Understood. So I helped them file it, and that was free, but that was no help. And we could talk about other issues that I'll touch on later, but let me talk about them now so I get it all in one shot. In regards to analyzing aid packages, it's very difficult for a student to go to a guidance counselor and ask the guidance counselor to evaluate all of their aid packages. Guidance counselors in the school that I taught, 2,100 students in the school, a guidance counselor for each grade. So that was 500 students per guidance counselor. There is no way the guidance counselor can evaluate all of the aid packages. And even if the guidance counselor could, if the guidance counselor does not know the expected family contribution and does not know what that specific school is supposed to be providing, How can the guidance counselor evaluate the aid package, number one, and number two, write the letter? In regards to filing the FAFSA every year, the students in college, is the student going to go to the guidance counselor in their sophomore, junior, and senior year of college asking for the guidance counselor to help them file their FAFSA? In regards to writing essays for colleges, do you think the English teachers in the high school have time to evaluate every single one of their students' essays for college and essays for applications? They just don't have the time. So when it comes down to what guidance counselors can and can't do, there are things that they just can't do. Okay, now we have this slide that talks about financial aid offers. I don't have to talk about guidance counselors now because you understand. But how is a family going to understand if they're receiving the right amount of financial aid? We will generate letters for the family. The SAT and ACT people say that you cannot really study for an ACT or SAT test, but one can prep for an SAT or ACT. The more time a student spends studying and prepping, and the more times they take the tests, the better they do. The bottom line, though, is whether a student is using a study guide with a DVD and online access, or just goes through straight online classes, or goes through classes where they attend personally, if a student does not apply themselves, it's not going to make a difference. But the more these students prepare using these Kaplan materials, they can increase their scores by 20% or more. The higher the scores they get, the better schools they get into, the more financial aid they receive. There's a script, obviously, on this slide, but I want to run some numbers by you. And this is if a student spends 6 years in college, and it's a conservatively priced college, let's say $20,000, $25,000 a year. For the 5th and 6th years, that's $50,000. If the student is not working in those 2 years, it's an additional $50,000 lost in income, let's say $25,000 a year. So because the student is going to school for 2 additional years, it could be net loss of $100,000. This could be worth a significant amount of money if the student applies the career and college planning tool. Additionally, it will help the student to develop a professional resume upon graduation and show the students their job fields and the pay scales. Very valuable tool. I need you to memorize the 5 points on this slide and the 5 points on the next slide. You should repeat it to the families twice. The reason why is because there's a dollar value for every single item. On point number 1, the student profile report saves the family hundreds of hours, if not thousands of hours worth of research and compiling information. Point number 2, understanding what the expected family contribution is and can be is very important. Filing the CSS profile and knowing the ins and outs is very important. If a parent doesn't understand the significance of where assets are, it could affect what they're expected to pay for college by a great amount. The college search is great. Not only does it show the student the schools they can afford to go to, but it gives them the ammunition to speak with financial aid officers, knowing what their student's supposed to be receiving even before they go and speak with them. When we run reports for families, they will typically list 2 or 3 schools, typically state schools. We add an additional 5 or 6 schools. When the families see in the report the amount of money that other schools provide, they come back to us asking us to rerun the report with schools. Now they have their major, they know specifically where they're looking to go, and then we can provide the schools that provide the greatest amount of financial aid. We evaluate the essays. It could cost $1,000 plus to pay somebody to help a student write an essay. These schools now are weighting the essays almost as much as they're weighting the SAT or ACT scores. So if a student does not write a good essay, they might not be accepted to a school. And even if they do get accepted, they might be stuck taking remedial English in college. Point number 6, negotiation team. Obviously, it's important to know if a student is receiving a good financial aid package, and if not, request more. If you ask a school to negotiate, they will say they do not negotiate. But if you request reevaluation, they will ask you to send in a letter. It's amazing the way a question is asked, the response one will receive. The SAT, ACT study prep guide. Graduating college in 4 years. Understanding the loans that are out there. Speaking with somebody like you and being able to refer back to us, the senior college counselor. College counselors charge $180 an hour. If a family spends 10 hours over the course of a student's college career speaking to a college counselor, it can run them $1,800 anyway, minimum. And finally, you and us, we and you, or you and us, are available for a conversation anytime during business hours to speak with families. And believe me, we receive many phone calls from affiliates and from parents every day with questions. I've helped individual families save thousands of dollars on any one of these points. So $16.95 is very affordable. I've had parents who sign up their additional children. By the way, it's $450 for each additional child in the family. And they tell me, Steve, I cannot believe the services that you provide. It is so worth it. Finally, at the end of the seminar, you are going to be opening the floor to questions. Do not concentrate too much on any one particular family. If you do, you will lose the attention of the other families. If you go on and speak about 529 plans, but they don't have 529 plans, they're not going to care. If you start going on and on about custodial accounts, they're not going to care. Do not give financial aid advice during this question and answer session. Oftentimes, you will find that your exact correct answer to one family might be the exact incorrect answer for another family. They need to come up afterwards and sign up for one-on-ones. Make sure that both parents will be available on the one-on-one. If one parent shows up, they will always defer to the other parent. If possible, have your appointment calendar available. So if you are stuck talking with one family, the parents can put their date and time in when they're available. It is very important to set the one-on-one appointment that day. To put it off and say that you are going to call them at a later date is not a good idea. They are going to get cold. But make sure that you create the need by telling them that you will address their questions on their seminar evaluation form when you meet with them in a one-on-one. You will discuss price with them when you meet with them on a one-on-one. There might be a case where, in some cases in California, we have affiliates that charge $3,000, $29.95. As I said earlier, some families you are charged $12.95. There might be a case where there's $1 million to reposition, and you might be making $50,000 in commission. You might want to choose to pay the $845 yourself, but do not discuss the prices with the family during the seminar or right after the seminar. If you have any other questions, obviously I am open to calls. Please enjoy your day. I'm going to end the seminar now. Bye-bye.